Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, thanks for tuning in this morning. I'm going to be doing this show today blind. By that, I mean I don't have my computer ready. I have to run out in the during the commercial break and see if I can pull up my password and user ID. Doesn't that kill you? Now you have to have an account for each and every device that you have. And then if you have a Microsoft operating system, you have another sign in for the new system that's online and updating and watching everything you're doing, by the way. And same thing with Apple. Every device has got to have its own user. I have a password manager, and I've got over 200 passwords. In fact, I'm afraid to count. Yeah, but I've got over 200 passwords and user IDs. How do you possibly keep up with that with a tablet and a piece of paper? I'm sorry, and a pen. Tablet and a pen. There's no way. So I have a software package that I have to update the user ID and password for to be able to log in and find one of the couple hundred passwords and user IDs I need to get the thing I need to get done at that particular time. And that is mind-boggling. It's so frustrating too. And then in Microsoft's infinite wisdom, they make you change their password every 90 days on the device. This is nuts. I can't wait until you've got the ability to just scan your fingerprint, let it, look at your eyes, do a facial recognition. That's here, by the way. They have that software. I just haven't had the guts to put it on my equipment yet. I'm going to wait until it's actually become very common. So maybe I'll try it on my home PC just for the heck of it. Yeah, but I hate to get locked out of something though. Yeah, I'm sure as soon as it does the facial recognition, I'll get a black eye and it won't recognize me, and I'll be out for a week. Anyway, I've got a quick phone call, 216-901-0945, 216-901-0945 if you'd like to call us. And I'm going to go right now to Bob. Bob, you have a question?
Hi, Bill. What do you think is a reasonable cash or emergency fund if you're getting close to retirement? And I would tell you our assets are a little over $2 million right now.
Okay. Do you know what your average monthly expenses are?
I would say yearly we probably spend in expenses about $45,000 to $50,000 a year.
Okay. Well, that's very good. The traditional, CFP school says 6 months of living expenses. That's the traditional. Having said that, everybody's a little bit different. I tend to keep about 20% in things that are like super short term. There's a senior loan fund. It's an ETF that invests in senior loans. They're AAA rated. The interest rates are typically higher than CDs are. They adjust to interest rates much more quickly than CDs do. Not quite as fast as money markets are, but they pay a lot more than money markets do. So I normally keep about 20. I have 20% of my own money in that. And so 20% of your total is way more than you're going to need for, 4 or 5 years. And I think that's a really good idea. Always carry some cash equivalent or something that's close to cash. That's not actually cash, by the way. Cash is a money market, and you won't make much money at all in a money market. But when it comes to that, everybody's going to be a little bit different, and you'll probably get a different opinion depending on who you ask. So I generally keep about 20% of my total assets, and it really depends. That's because today that would, I could spend 20% of my assets. That would support me for several years. And you would be in that same situation. So
a follow-up, Bill, if we have currently $150,000 in cash, and that is in money market kind of funds, money market. Do you think that's overkill?
At a $40,000 a year that you're spending, maybe a little bit. Maybe keep it down to around 100. That would go for 2 years. But you still have to take a look at the other aspect of that too. I try to keep enough stuff that's not going to fluctuate very much, so that if I had to start withdrawing from it, that I could withdraw for at least 5 years. And that's what we do with everybody, because most of my clients are older, and they're already a large percentage of them are already supplementing their income with their investments. So we try to keep 5 years worth of withdrawals in something that's as safe as it can be, but not necessarily a money market.
Okay.
In that way, and if you have a correction, you should be able to recover during that time period, so that you don't have to spend too much of your principal, because that's actually how people go broke. They're too heavily invested in the stock market, and when they get a big correction and they still have to take money out, to live on, it ends up they're not able to make that money back, and that can be a real problem in retirement. If you're not retired, it's a little bit different, but and again, everybody's situation is slightly different. And I never agreed with it's really hard to make a statement across, a broad group of people and say, well, everybody should do this. Everybody's situation is a little bit different. So, and they have different comfort levels. And I meet with clients all the time who have 50% or more of their assets in those short-term income securities because they're not comfortable putting up with the volatility of the market. And that's great. As long as you're aware of it and you're picking out from those things, those options that somebody laid out before you and said, hey, okay, here are the characteristics of this portfolio. Here's this one and here's this one. Typically, it's how we'll work. And which one do you like the best? Looking at worst case scenario, you need to include that in there. And then that's something that, by the way, very few financial planners talk about. They talk about standard deviation because it's a smaller number. It's not as threatening. But when you take the average portfolio and you look at how that would have performed in 2008 through 2009, most people would go, wow, I had no idea I was taking that kind of risk. And that's why people don't trust people in my industry. And I don't think it's anything, you shouldn't hide it, because you're going to experience that at some point in time if you live long enough, and you need to know about those things, if you're investing that way. Just like the fixed income. How much fixed income do you need? Somebody that is only spending $40,000 a year and has a $2 million portfolio, as part of your normal portfolio, you would have way more than you would need for emergency situations.
Right.
So it's up to you. Whatever you.
Okay, Bill, I appreciate it.
Well, hey, thanks for calling.
Okay, bye-bye.
Bye-bye. I hope that helps. That's a very, very tough thing. Again, emergency situations, historically 6 months has been kind of the average that they recommend. But I think, if you step back, how much in fixed income do you have that's not going to fluctuate very much? That's kind of a big deal, especially if you're already withdrawing money. And that's another thing. If you own your own business and you have a pretty substantial income, then the number for you is going to be different than somebody who is completely reliant on their employer. When the employer, if your business slows down a little bit, you make a little bit less money, or you end up having to reinvest in your business. It's not like losing your job. So again, everything is individualized. We try to keep it that way at Bullington Capital. So if you actually have questions like that, you can always call us in the office to 330-664-0700. I'll be glad to look at your personal situation and give you an idea of what we should do. I'm going to go back to the phones right now, and I have Daryl. Daryl, you have a question for me?
Hello, Bill. How you been? Been a long time.
Oh, hey, how you doing?
I'm well. I'm better. Thank you. I had a little issue with my ankle, but I had it fixed about 3 weeks ago, and Actually, they took it off, and I'm waiting for my prosthesis.
Oh, wow.
Yeah.
Man.
Yeah. So
How does that
I
feel?
haven't been able to walk since Christmas time, so
Oh, man.
I'm looking forward to being able to get back on my feet again.
Yeah, I can imagine.
But anyhow, I have a solution, or at least a suggestion for you about your password problem. I found a piece of software, and you said you were using something.
Yep.
Is it Dashlane by chance?
No, I did look at that one, and we ended up going with LastPass, and we have the enterprise version.
Okay.
Yes.
Because Dashlane works good for me. I use it across all of my computers and phones and tablets.
Yeah. I've heard really good things about it, by the way. I've had
and I often forget a password, and I can go log into the to the main page and scroll down, and it stores payments also.
Yeah. Oh, that's cool.
It's pretty slick. I wish I was getting a commission for selling it.
Yeah. Yeah. Yep. Yeah. It's amazing. I was thinking about that. I think about it a lot, actually. How technology has changed so much, and really, it's improved our lives immeasurably. And the generations that grew up with all this technology have no idea what it was like, before this existed and what we had to do back in those days. And I think it's kind of funny, but it's really amazing how much easier a lot of things are. So you have a new set of challenges. Back in the old days, you didn't worry about it because you didn't have time to worry about it. You're doing everything by hand.
Right. Yeah.
Well, now you've got more time.
I just got another slick new device called a WiseCam, WYZE, WiseCam. For $26 shipped. You plug it into a wall house current, and it has a microphone and a speaker on it. You download an app onto your phone, and you can watch the inside of your house, the outside of your house, in real time. Mm. And if you plug a SIM card into the a memory card into the camera, it'll record 24/7.
Wow!
It'll also monitor your smoke alarms.
Oh, that's cool.
So
hey,
if your smoke alarm goes off.
Can you send me a link to that?
Yeah,
I'd like to take a look at it. Yeah. And
I'm wondering if
this is kind of what I was talking about with the 5G. That technology will, at some point in time, it's probably using Bluetooth right now. At some point in time, it's probably going to shift up to 5G. They'll make some sort of a alternation. They're basically using different types of semiconductor chips to be able to transport the data quicker and use up less, and do it more efficiently.
Yeah.
So that.
Yeah, I set this camera up in the front window of my house, and it's looking down the driveway. And right now I'm looking at it, and I can see if somebody's walking up to my front door.
Yep.
Or trying to pry my garage door open. It's amazing. And because it's got a speaker on it, so if you see somebody, you can start yelling at them.
Oh, that's funny. Hey, who knew that Judgment Day was going to be a computer? recording everything you do.
Hey, I look forward to being able to, maybe not the next seminar, but maybe the one after that. I'll see if I can get to it. But thanks for all you do to help out my retirement wealth, and I look forward to seeing you soon.
Okay, that sounds good. Have a good weekend, and thanks for calling.
Thanks,
too.
Bill.
Yep.
All right, you bet. God bless. Bye-bye.
And speaking of that, it just dawned on me. So he's got a couple of businesses. In fact, we should. I'll mention them. I have to put together a spot for that. Anyway, business owners. If you have a small business, if you have income from a part-time gig, or you're an independent contractor, which happens quite often, there are retirement plans you can take advantage of, and they're constantly changing. By the way, in fact, I learned something this week. The 401k, a Roth 401k. Let's say your company offers a 401k, but because they have people that don't contribute much to it, it limits the amount that others are allowed to contribute to it. In a Roth IRA in your 401k, I just assumed it would be the same thing, but the rules are significantly different. In fact, I just started delving into it because it was brought up to me by a client. And a Roth IRA does not affect your ability, from what I've learned so far, to invest in a Roth IRA outside of your 401k. So you actually got an extra, $5,000 or $6,000 there, depending on how old you are. So that's pretty cool. That's a nice thing. I thought that they would definitely restrict the contributions to Roth IRA outside of that, and looks like it's a little more free or a little more flexible than I thought it was going to be. So that's nice. So that's a really big deal. If you're a independent contractor or a sole business owner, sole proprietorship, even if you have a business but you're the only employee, you can do some amazing things with defined benefit plans for yourself. Defined benefit plan is a plan where you're going to put in much more on average than the average contribution to a 401k or a profit sharing plan. So if you got a small business, you got questions on that, feel free to email us. Go to my website, bullingtoncapital.com. Just feel free to do that, because that's a big deal. That can be a really big deal. Being able to take advantage of stuff like that can make a big difference in your life at some point in time. So we'll be glad to look into that for you, do the research, find out what you're eligible for, how much it might save you in taxes, and it's a great thing. We'll be talking about that on shows regularly from now on, because I know there are people out there. Some people have been able to are self-employed, been able to go back and make contributions for prior years and get back some of the taxes they paid in those years. How cool is that? So we don't really know until we sit down and have a conversation. So if you're interested in talking about that, just shoot me an email off of my website, bullingtoncapital.com. Just contact us. I got to take a real quick commercial break. So while we do that, just stay tuned. You're listening to Bill Bullington here on 1420 The Answer. I'll be right back.
I've been winning battles left and right, but
Our scars are a sign of grace in our lives.
And we're back. Hey, you can call us 216-901-0945. 216-901-0945 if you have any questions. We're talking a little bit about a lot of different things, actually, but tax returns are actually tax-saving plans if you're a small business owner. Boy, you can do a lot now. I mean, it's amazing what you can do. You can actually get these pensions that used to be incredibly expensive to administer and put in place because of all the calculations that went into it. And you used to have an actuary, and those guys charge a whole lot of money. Well, now with all the computer software that's out there, you can get it for a whole lot less money. And if you're a small employer, you might want to look into that. It's pretty fascinating. It's a good area. So if you just have questions, feel free to give us a call. You want to see what it's like, what you might be able to contribute to. Some people contribute over $200,000 a year. I mean, that's crazy. Be able to take and write that off. Wow. Wish I were in that category. I'm not. Yeah, there's special categories. I get to do a lot, actually. It's pretty nice. But anyway, so if you're interested in learning more about that, and it doesn't necessarily have to be your day job. If you have a part-time job, you got a blog, you do some photography on the side, you can set up a retirement plan for that income and put some extra money away. So again, just give us a call. The other thing I wanted to talk about today, a lot of people have some annuities around that may be older, and the older annuities typically had much higher expense ratios. In fact, the expense ratios can be significantly higher on a product that's 5 to 10 years old than the new ones are today. So you may want to take a look at that too. So we've been using an investment-only annuity. It doesn't have any of the insurance benefits unless you want to add them to that. But it comes basically, there are 350 some odd funds because they keep adding to it all the time. Your favorite fund families, there are a ton of fund families that are involved in that. Fidelity, Vanguard, T. Rowe Price, you name it. They're typically in there. You can exchange, and this is the part about annuities that should be very attractive to most people. It's a tax-deferred thing. There's no limits as to how much you can contribute to it. You only start to pay taxes on a portion of your gain when you start to pull the money out. You don't want to start pulling it out until, it should be for retirement savings, because if you start pulling it out before 59 and a half, there's a chance that you might have to pay a penalty tax on the income portion. And it's got but the tax deferral is a big deal. Whenever you change or you rebalance the portfolio from one fund to another, you don't get a 1099 on that. And that's what attracted me to it years and years and years ago. You used to have products that had insurance benefits that you could buy. You could add to it. I don't really use too much of those anymore. The prices on that kind of stuff have risen so much so since I first started using them that I just can't justify it. And it's kind of been that way probably, I don't know, maybe 10 years. And again, every company's a little bit different. So you can't really make a blanket statement, but a lot of the products that I used to use, the fees, the internal fees went up pretty dramatically. And sometimes, people are paying as much as 3 or 4%. Some of them are paying as much as 10 or 15%, and they're not aware of it. And what's really hard is for the average person is to look at the costs on hedging a portfolio. That's what these equity index annuities are. The costs on that are astronomical, and it's not the cost that you see in the contract. It's the carrying costs that are built into the investments that they're putting the money in. What they're investing in has a significant amount of carrying costs that they do not have to disclose. You start putting that in there, and it's really, unless you're making 10 or 15% on an average annual return basis a year, you're not going to make any money. If you do make any money, it's going to be a super small amount, and you could do better than that in a short-term senior loan fund or a mortgage-backed security fund. So I probably sound like I'm speaking in circles here. So the bottom line is, if you've got an old annuity sitting around, you might want to take a look at it. The newer products have come out. They're more streamlined. They've got lower expense ratios. That's been a trend over the past 4 to 5 years, maybe actually more like 6 or 7 years, where the costs, they've stripped out all the extra costs. All you're paying for is the administration of it and the tax deferral, and that could be as low as $20 a month, even if you've got a few $1 million in there. That's a good thing. It can be very, very, very helpful. If this is money that you're setting aside, you're already maxing out on your 401k at work, you can't contribute any more to that. You're putting money aside for retirement savings or savings you don't plan to touch until you get much older. Putting it into a investment-only annuity could be a great idea, because now you can not worry about getting 1099s every year. The money that you would have paid in taxes stays in there, continues to compound, and continues to work for you. So, and the products that we use at Bullington Capital are not commission-based. There are no commissions that are paid. And you typically, I hear, never mind. It's just, there's no commissions. If you took the money out, you're not going to pay a fee. So that's what I'm telling you. There are no market value adjustments, by the way. It is what the account value is, the account value you get if you decide to take it out. So again, if you've got an older product, might be a good thing to have it looked at, to just see what your options are. And we'd be glad to do that for you. And just go to my website or call us, 330-664-0700, and be glad to provide that service. I think it's a really good thing. There's a really good opportunity, because stocks, it's interesting. Stocks are down quite a bit over the past few months, which is normal. The fact that it went almost 2 years without a 10% drop is not normal. I know it's what everybody was hoping, that it would always stay that way, but that's actually not normal. To have drops of 10, 15, 20%, that's pretty normal. That's actually how the long-term average was accumulated. You get some pretty steep drops followed by some pretty fast increases in values in stocks. And that's why it's so hard, by the way, because it changes, and it changes fast. And volatility levels have been picking up, especially the shorter term volatilities. The longer term volatility levels, if you look over a year or two, it's about the same. And actually, it's about the same as it was in the early 1900s. People don't realize, if you looked at a chart of the Dow back in the early 1900s, that was volatile. That was really volatile. That's why so few people invested in stocks. The market scared them. They were scared. Little did they know that's just kind of how it works. And there is a way of controlling that. The way that you control that is you don't invest everything you have in stocks. The vast majority of people I shouldn't say the vast majority of people that fail try to time it up. They try to jump in and jump out at the exact right time, as if, and somebody else hadn't thought about that before and tried it. And if you do succeed at doing that, you have to keep doing it, because eventually luck has a tendency to run out. So I'm not sure that's the best plan for you. The better plan would be to have a certain percentage of your money in stocks and plan on adding to it at some point in time. If they're down a lot, plan on taking some profits out. If they're up a lot, looking at what are stocks actually worth versus what are they currently selling for. When you overpay for stuff, it's really hard to have a decent return on that. It's a lot like real estate as far as that goes. If you overpay for a piece of real estate, you may not live long enough to recoup your money. Let's say you bought a house, $150 a square foot, which is pretty high. $150 a square foot, but every house in that neighborhood was selling for that price because it's newer and they're nicer, and the school system's really good, and people thought, okay, that's a pretty good deal. Then somebody comes in and pays $300 a square foot because they're from Saudi Arabia and they don't know any better. They don't necessarily have to be from Saudi Arabia not to know any better. But you get my point. Somebody comes in and overpays. Well, that person may never live long enough to get the money back that they spent on that house. And the same thing can happen with stocks, and it does. And putting a valuation on a stock, I feel so bad for people. They make this so hard. The complicators of the world. It's not that hard. It is not that hard. In fact, we've got a seminar coming up, and I can't even remember what it is. I'll have to talk about it the last portion of today's show. It's relatively soon. You can go to my website and find out, by the way. It's bullingtoncapital.com. And I will actually try to look that up during the next commercial break. But my point is, you buy a stock and you overpay for it, it could be a great company. I'll give you a real good example. Intel's one of the better companies that's ever existed. They got to be in the top 50. And Intel is selling below a price that it sold for 18 years ago. 18 years. Okay. And the problem is not with Intel. The problem was with the people that were investing in it. They just kept buying it and pushing the prices higher and higher and higher. A lot of them didn't even know they were buying Intel because Intel makes up is in the S&P 500. And when the S&P 500 has a stock that goes up in price and goes up faster than some of the smaller ones, they have to add to that holding. So if Intel happened to be 2% of the index one year and 3% the next, they're going to have to sell some of those other stocks and add to Intel to bring it up to 3%. They're adding to it after it's gone up. And that's one of the problems that I have with market cap weighting. It causes bubbles. And then when those bubbles crash, like the S&P did and started in 2000 and ended 3 years later, that's another thing that kills me. Market cycles are not 12 months. nearly all the math that's involved in telling you how to invest using modern portfolio theory is based on a 12-month time period. The markets never, ever began and ended a cycle in 12 months. Ever. Do you know why they do that? Because I shouldn't say it. Because they need something that they can use mathematically, not because it works. There's a subtle difference there. So anyway, the bottom line with that is Intel, if you overpay for something, you're probably not going to make a lot of money on it. Now, if you figure out how much to pay, or let's say you've got a mutual fund or an exchange traded fund that buys stocks based on valuation, that means a valuation is a fancy word for how much is that thing really worth. If you have a strategy that does that, okay, two things are going to happen. Over long time periods, you're probably going to perform well enough to be happy with it. You probably will. In the short run, the people that keep buying stocks and pushing them higher are probably going to outperform you. And from time to time, they will. There's no doubt about it. There was a time when buying Intel, Microsoft, Cisco Systems, EMC, anything related to tech, made you look like a genius. And it lasted for almost 5 years. That's a long time to think you're a genius. And then to see those stocks drop by 80% or more, to give up most, if not all, the gains you had and turn you back to negative, because sooner or later, what they're worth tends to matter. That's what happens. Sooner or later, what they're worth tends to matter. So if you've got a good strategy and you really understand it, you like it, you should pay attention. You should go back and learn and just pay attention to the strategy. But the strategy is what's going to really help you in the end. The fact that you have one puts you way ahead. Kind of like that annuity that we were talking about, the investment only annuity. There's a strategy I like to use with that. They've got 300 funds in there. I like to take the broadly diversified funds, the ones that represent large, medium, and small U.S. companies, also those that represent emerging markets and international, more established indexes like the ones in Europe. And we take the top two performers, and every quarter we go back and we look at that, we rank them, and we hold the top two. We hold a certain portion of the money in short-term bonds in there just to keep the volatility down. And we look at that and we manage that on an ongoing basis. And I've been really pleased with the results of doing that. So it's and we don't get, what's really nice about it is we don't get hit with taxes when we're making those exchanges. That's awesome. So, but that's a strategy. That's having a strategy. Is it perfect? No. Sorry. There aren't any perfect strategies. All strategies have some sticking points or some things that could make you uncomfortable from time to time. So you have to get familiar with what they are. And in order to be familiar with what they are, you have to know what you're doing. And, these are all the things that we'll be talking about at the upcoming seminar. And I'll actually advertise that after these commercial messages. I'm going to take a real quick commercial break. You listen to Bill Bullington right here on 1420 The Answer. Stay tuned to find out when that seminar is. Thanks.
I've had just enough of the spotlight when it burns bright to see.
And we're back. Hey, you're listening to Bill Bullington here every Saturday morning from 11 to noon. This is you can also catch the show on 955thefish.com's podcast, or you can go to my website and download it and listen to it there if you'd like to. That's bullingtoncapital.com. You can also sign up for the next seminar. That's actually Thursday, May 10th. It's going to be 6:30, Corporate College. all the instructions on how to get there and signing up are on my website. If you don't have a computer, you can call us at 330-664-0700. And what we're going to be talking about are basic portfolio management skills. And there are a lot of reasons that you may want to learn how to do this. Not because you're going to do it yourself. If you wanted to, you could. But more importantly, it's very important, I feel like, to be able to know what portfolio managers are doing so that you gain a level of comfort with your investments. The more you know about it, the more you can relax. If I know, say for example, one of my favorite models, investment models, is to look at the amount of cash, EBIT if you're a CPA out there, and it's it's an estimate of cash flow. I like to divide that by the enterprise value, which is the cost of buying the entire business if somebody were to acquire it. Okay, and I'm keeping these definitions intentionally short. And there are some things that I'm leaving out because I don't feel like they're all that substantial. And I need for the public to be able to kind of get a good grip on it. And besides, they have Investopedia and they can look this up anyway. So if I take the this estimation of cash flow, divide it by what it would cost to buy that business, I get a yield. Now I can compare that yield to yields of buying other businesses or making other investments like 10-year treasuries or CDs. Okay, that's all I'm doing. I want to convert the cash that company's generating to a yield so that if I were to buy the whole thing, I can compare doing that versus putting my money in something like a CD or a mortgage-backed security or another stock. We can compare everything. We put them on a level playing field at that point. And why would I want to do that? Well, first of all, it's not that hard to learn if somebody shows you. Secondly, when you're looking at a mutual fund that you might be invested in or interested in investing in, you can look at the top holdings. You can do those calculations and see whether or not those stocks are overpriced. If they're overpriced, I'm going to tell you, find another fund. Now, don't overpay for something because it's done so well in the past. That's the kiss of death. You want to invest in something because it's got a decent track record or a good track record, but you want to make sure they're still doing those things and paying attention to what they own. And if they're buying stuff that's overpriced, it's not a matter of if that's coming down, it's just when. And that's not fun. Not fun to overpay for stuff. It may make you feel good for a little while, but 4 or 5 years from now, or 8 to 10 years from now, when the reckoning day finally does come, you're not going to feel good at all. And if you can avoid doing that, I think you should. And that's why we're talking about this. Learn basic portfolio management skills, basically so you don't have to. But so you can be an informed investor. You can know a lot about what's going on in the funds. And I'm going to break this down. I was just laughing. I got these cards. I bought them from Amazon. I thought, well, maybe there's something that they've added in here over the years. And they're all on finance. And I'm looking at the math, and the mathematicians have taken over, by the way. They have just taken over. I remember once Warren Buffett describing the people who came up with modern portfolio theory as witch doctors with PhDs in computers. And I understand that. It doesn't need to be that difficult, and it's really not. A lot of what they're doing is not very useful in practical applications. In other words, when you put it out in the real world, it tends to fail. So you want to kind of steer clear of that stuff. And we can talk about that. You want to call me, have a conversation? I got no problem with that. In fact, I enjoy that sort of thing. But the average person really needs to have a good basic understanding. Why have I been talking about Procter & Gamble over the past few weeks? There are lots of reasons. If I take the amount of cash that company generates and I divide it by the total value of the company, if somebody were to come up and buy that, and I'm going to stop you right here for a second. Every time I say that, 9 out of 10 people go to me, they'll stop me and say, but I'm not going to buy the whole thing. Yes, but when you're buying a single share, You are buying a piece of the whole thing. You're investing in a business. Why would you buy one single piece of something if it's overpriced? You shouldn't. And I know why you do, because you read and you think, oh, well, it's just going to get more overpriced. And you know what? That it might. But you have to rely on luck to make money that way. And you're gambling. That's not an intelligent investment. That's a gamble. So how much cash does a business generate, and how much are you paying for that? If you bought the whole thing, what would you get? What is your return? What's the yield? And if the yield, if you're willing to take a 1 or 2% yield, or if you're willing to invest in a company that's losing money, because there are situations where companies that are losing money will end up selling at a higher share price today, but that's beyond the scope of today's conversation. And I can tell you that those are about 1 in 1,000. So that the odds are not real high when you invest that way that you're going to do extremely well. Typically, companies need to be making some sort of a profit. Now, they can have a bad year or two. They all will at some point in time. And there are things that you can do to adjust for that too. But all other things being equal, how much cash is that business generating for every dollar that it would cost somebody to buy the whole company? And we're going to talk about it in terms of a yield, because it's easier to relate to, I think, for most people if you look at it as a yield. If I wanted to buy a business and the yield on that business was 10% and I'm looking at a 1% CD, what am I going to do? I think all other things being equal, just looking at the 10% versus other, I would do the 10%. Now, the next thing I would ask is, why is that yielding 10%? I mean, that's a lot, right? There's typically a reason for that. And that's when the real research begins. What's the reason for that? Maybe they've had a problem. Maybe that problem's going to be as big as people think it is, because it wouldn't have a 10% yield. That's a lot of cash to generate. People normally, when they're panicking and selling, that's what causes the yield to go up, because the share price has been dropping quite a bit. So they're selling it. And if it's overdone, if those fears are not warranted, that stock may go up a lot at some point in time. And that's kind of, one of the things that we'll be looking at. That's what a portfolio manager does. Tries to figure out what he thinks the business is worth, tries to get it at either a fair price for a business that's growing very quickly, or tries to get it at a good price where the business may not have a lot of future growth. If you can get something cheap enough, and you can still make money with it, even if it's not a great business. So that's and nobody's teaching it this way, I promise you, because I look all the time. And I really feel bad. I feel bad for the public, because it is hard. I mean, you look at this kind of stuff that they're putting in business school today. Where on earth is that ever going to be applicable? It's going to do what it did to me when I got out of school. It's going to frustrate you. You'll be frustrated. I really feel bad for the kids, because they're using so much stuff, and they use only the data that supports their argument. Any data that doesn't support their argument, they don't talk about, and that's hard. You're making it hard on the kids. So let's try to make it easier on the kids and everybody, by the way. Another reason that you might want to learn basic portfolio management skills, if you know what you're doing, you reduce the risk of running out of money during retirement. The more you know, the less the chances of you running out of money in retirement are. So I think that's a pretty good benefit. And I talked about, I'm going to break this down. I'm going to make it really simple for you. And so you can get the basics down. I'm telling you, all that fancy math, it's good for less than 5% of your performance. But you will spend hours, weeks, months, and years studying that stuff, for some of you, increase your performance by just a little tiny bit, and there's no guarantee that it will. So I don't know. Might want to keep it a little simpler. That would be good. The peace of mind that you get from that, the peace of mind that you get from constantly being able to look at something logically and determine, okay, they're a little over optimistic on this one, or they're a little under optimistic on this one. You're going to put yourself in a position to recognize other portfolio managers, or work with somebody like myself The more you know, the easier it is for me to work with you. That's another reason that I do this, because I've been asked, people say, well, you really must love teaching. No, I like being in business. Yeah, and teaching's just a part of it. Because if you're on the same page that I am, you know what I'm doing. You tend to stay out of my way and let me do what I got to do. That works out really well. But you need to know. And now that I hear the music, I need to know that this show is over for the week. You're listening to Bill Bullington here every Saturday morning from 11 to noon. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.